Hello everyone. Now we are gonna do the sensitivity scenario and simulation test and then do the summary for the intrinsic share price. Let us start. So here you can see we are gonna do this sensitivity analysis of intrinsic share price to the changes in the terminal free cash flow to the firm growth rate and weighted average cost of capital. Now, in the middle column, you can see we start with the terminal growth rate we assumed here. So what you need to do, you need to just copy it and then paste it as a text. This is very important. You need to paste it as a text. And then you need to increase this terminal growth rate by 0.5% as you move to the right and decrease it 0.5% as you move to the left. The same way, the middle row here should be the weighted average cost of capital we used. So here, this is the weighted average cost of capital we used. And then you see this is the benchmark, and then as you move down, you are going to increase the weighted average cost of capital by 0.5%. And then remember, it is discretionary. You can increase it by some other number, and I reduce it by 0.5% as I move up. All right. And then in the intersection of these two factors, I should get the stock price I estimated here, 164, right? So, and then here, the cross section of this, terminal growth rate and the weighted average cost of capital, you need to link the specific cell for which you want to calculate the sensitivity. So I want to calculate the sensitivity for the stock price. So you can see, I just link it there and then select the entire area, check data, then what if analysis, data table, and then here your row input is your terminal growth rate, your column input is your weighted average cost of capital. Okay, now you can see the middle one is the price you estimated here, and then you can see here the range of the price you see is from 119 to 257.8 based on the sensitivity analysis. Now we are going to do the scenario test. For scenario test, you can change multiple factors at a time. And here we choose to change all the factors related to the operations. And here we have 4 scenarios. You can have multiple scenarios: excellent, good, bad, and worst. In the excellent case, all the factors should be at their best level, and then thereby the free cash flow to the firm you estimate in the excellent scenario should be highest among all the scenarios. And then as you move from excellent to worst, all the factors which are positively associated to the free cash flow to the firm should get worse. And then all the factors which are negatively associated with free cash flow to the firm should get better. Okay, as you can see here, sales growth rate, it is positively associated with free cash flow to the firm. So you can see here, we have the highest sales growth rate in the excellent case, and then it decreases as we move from excellent to the worst case. The same way, cost of goods sold as percentage of sales, it is negatively associated with free cash flow to the firm. As your cost of goods sold goes up, free cash flow to the firm goes down. So we have the lowest cost of goods sold as percentage of sales in the excellent case, and then we increase it as we move from excellent to the worst case. So this is how we get different numbers for all of these different factors. Now, to run scenario analysis, what you need to do, again, go to data. Then here, you need to first select the base rate. So here, you need to select those values of those factors in the very first forecasted year. In this case, 2022 is the first year, in my forecasting years. So I choose those here and then move to what if analysis, then scenario manager, and then here plug in all of those scenarios. So for example, I want to plug in excellent scenario. So I'm gonna add, and then I'm gonna give it a name. So for example, excellent one. Then hit OK. Now you need to plug in numbers, type in numbers here. So for excellent, say for sales, I have 29.39%, that means 0.2939. And then for the next one, I have 0.5782. For the next one, I have 0.0744. For the next one, I have 0.3234. For the next one, I have 0.1612. Then I have 0.0119. Then I have 0.1387. Then I have 0.0998. Then I have 0.2019. At last, I have 0.1287, and then hit OK. Now I can see you have a new scenario named excellent one. So this is how you actually form all of these scenarios here. I already have excellent here. For demonstration purpose, I create this excellent one. I don't need it, so I'm going to delete it. So select this one, then delete. Now, once you are done with this one, hit this summary. For the summary one, I want to check the sensitivity of share price and say estimated net income. You're going to choose anything else, and then say, for example, value of operation, whatever you want, then hit OK. Now a separate sheet for the scenario summary will be created. Let us wait. You see, the scenario table is ready. For the base case here, we are going to get the same value for stock price we estimated here. So our stock price estimated here is 164. That is the exact value we get here. Why is that one summary? Here, 164. Then your net income 111 million. You see, now you also get the stock price, net income, value of operation for all the other scenarios. And you can see here, you get highest stock price, free cash flow, value of operation, net income under the excellent scenario. All right, so from this scenario test, you can say, okay, net income for this company, in my opinion, will range from 85,505 million to 111.401 million. The stock price will range from $90 to $263. And then value of the firm should range from, from this value to this value. All right, and then scenario test is done. And again, I have a scenario summary here, so I'm gonna just delete this one. I just created this different scenario summary for just demonstration purposes. Now I'm gonna do this simulation test. So first, I'm gonna just copy the share price. So share price here estimated is 164, and then standard deviation. I'm gonna get this standard deviation from the historical share price of Apple Incorporation. So you can see here, and that standard deviation is 48. Then I'm gonna do my first simulation. So it is normal, and then here my probability distribution should be random, so rand. Then I'm gonna choose this mean price. So mean price should be the price I estimated, and then standard deviation should be the standard deviation of the price I calculated based on the historical price distribution of Apple Incorporation. Then hit enter. Next, you are not going to have any of those. Next, for the very first one, copy the first simulation value and then choose all the trials. Here I have in total 1000 trials. And then again, on data table, here I just have column, right? So column value, choose any blank cell here, then hit enter. You see here I get simulated values. All right, next, let us create the summary, the very last page here. Now here, I just copied all the price I get under different scenarios and I give them equal weight. You can give them different weight. Provided you give them equal weight, then you can just take the average. And the average price here is $219. So my expected price here is $219. Current market price is $170. So my upside here is 28.58%, 54%. Then sensitivity analysis. Sensitivity analysis give me minimum value ranging from $119 to $257. Simulation test here, not much useful. But again, we get the minimum price $12, maximum price $307. For scenario analysis, we get minimum price $115, maximum price $339. So from this summary, your investors will realize, okay, this is a buy recommendation, but at the same time, to get this buy recommendation, this person actually relied on different scenarios ranging from excellent to worst. So therefore, this investor can feel more confident to actually buy your recommendation. Next, your sensitivity test, simulation test, and scenario analysis will actually provide a range for this customer, and therefore this customer will also understand, okay, the risk behind the investment in this particular company. All right, that's all for the valuation part. Thank you.